Got those fancy words that the recording is in action. Again, this is Patrick Luce, speaker and economist here at ITR Economics. Excited for another report review together where we're going to talk about everything, everywhere, all at once. And really today's key theme that I want to focus on is the transition that is coming within your industry. I think a lot of folks are still experiencing what we call at ITR the phase B accelerated growth. And it gets tricky at the top of the business cycle to not get caught in linear planning. And I'll dig into what that means by really showing you the chart that's kind of front and center at your reports, looking at MTI's average monthly sales. Things are still growing at, again, an accelerated pace. We call that phase B, the annual trend around $647,000 on a 12-month moving average basis. That's a 16.3% year over year growth. And while those sales remain in phase B, there's signals from the leading indicators, such as primary metal new orders and manufacturing capacity utilization, that suggests an imminent transition to that slowing growth phase C. And kind of looking at these charts and go left to right. Left is the data trends, that 12-month moving average, where we are expecting continued growth really the next 2 quarters, and starting to peak out around the end of this year, but more specifically into next year, where we see those recessionary trends take hold. And that's the 12-month moving average that we're looking at. And if we focus on the chart to the right, those are the growth rates, the 3/12 rate of change, the 12/12 rate of change, and our forecasts. And we're getting close to a key ITR economics checking point where that black line, the 3/12 rate of change, is very close to what we say downward passing the 12/12 rate of change, which suggests an upcoming phase signal shift in the 12/12 rates of change. And really, if I focus in on the expectations for the MTI members and where we're seeing the industry head, is to have that slowing growth really be the trend throughout the rest of this year in 2023, and closing the year about 9.4% year over year growth before that recession really takes hold, specifically in the second quarter of 2024, and persists throughout the rest of that year. And then recovery in the early parts of 2025 before entering re-accelerated growth phase B in the second half of 2025. And I know hearing the word upcoming recession is one that maybe sounds a bit pessimistic based upon the data that you are looking at. But as I mentioned, we want to avoid that linear planning. We want to look at what the leading indicators are telling us to make sure that that straight line forecasting is out of your planning mechanism. We want to use those rates of change in what the leading indicators are telling us so that you can plan accordingly, right? You don't want to get caught as a linear planner. That's kind of the Pelotons of the world who had these amazing 2020s, started to staff up and build up a capacity, and then got caught a bit flat-footed in the subsequent years when they couldn't reproduce that same growth rate. And so I want to dig into those trends, what the leading indicators are telling us for your industry specifically, and then talk about the individual markets and where there might be some opportunities to buffer the cyclical decline and recessionary trends that we are expecting. And so I got to start with the biggest of pictures here. Let's look at the global trends and what those headwinds are suggesting. And if I focus in on the global activity, I got to look at the big players here. And this is just a breakdown of world GDP, or percent of world GDP by country. And obviously, there's 2 really big slices of the pie, and that's the United States and China. And where both of us head, in the US as well as China, are going to have key implications on where the broader macro economy heads. And right now, the US industrial production sector is in slowing growth, as is the Chinese industrial production sector. When I look at the various economies through Western Europe specifically, they're already facing some of those economic challenges, having some of that acute sensitivity to the impacts of the war in Ukraine. And so we're seeing those recessionary trends already showing up there. And when I broke it down even further into North America, say Mexico and Canada, they tend to move pretty similar with the United States because we are that big dominant player. And I know a lot of times when I bring up the global economy, folks want to talk about China and China's rapid growth and how they're going to catch and overtake the United States. And I do want to take a quick minute to just discuss the fact that China is weakening. They're a rapidly maturing economy with a lot of challenges to come from a demographic perspective. And that China tiger of the early 2000s and the 2010s is unlikely to experience those 10, 15% growth rates that they were seeing. And in fact, when we look at the recent trends, China's moved a lot more similar to the pace of growth as the United States. And this chart shows exactly that. From a 3/12 rate of change perspective, we're focusing in on China's industrial production in dark blue versus the United States industrial production. And you can see that the peaks and troughs in that dark blue are on a descending trend. And that is just going to be consistent with the outlook over time, where that rapid maturity is going to result in a weaker economy there. Got to focus on just our neighbors as well. Obviously, China's a big global player, and I will talk a lot about the U.S. economy, but can look at the surface trade activity between the U.S. and Mexico, as well as Canada. And that's this light blue line here, where we're focused in on those rates of change in the overall trade within North America. And the reason why I wanted to bring this up today is because it's actually been a pretty good leading indicator for your sales activities. You can see the relationship that we've plotted here. And as a reminder, when we're looking at a chart with leading insights like this, in case where surface trade leads by 6 months, I've shifted that line, that light blue line, that trade, forward along the x-axis by 6 months. And what that surface trade indicator is saying is that there's an upcoming peak to come, right? That 16.3% year over year 12/12 rate of change in your MTI, average monthly sales, is likely to start to turn over soon. This is one indicator. I'm going to spend a lot of today's call looking at the other macroeconomic indicators as they relate to your sales. But again, as I'm focusing in on the global economy right now, I got to think about what this trade means for you. And the likelihood, or the reality, is that as wholesale trade and surface trade continues to cool off and enters into slowing growth, and when we think about wholesale trade in the US enters into recession, just want you to be aware of the likelihood of order cancellations. This tends to happen on the backside of the business cycle, and I want you to be protected against those risks. Make sure that you have contractual stipulations to hedge against them, and whether that's through penalties from canceling or through an upfront deposit, to make sure that you are insulated from those impacts. Now, a cool down within the global economy doesn't have to necessarily be overall negative. I can focus in on what it means for the supply side of the equation. And this is a great way to frame that, is focusing in on that dark blue line, which is the global supply chain pressure index. That has fallen below the long-term average, which would generally suggest that the supply chain issues are a thing of the past. But I know the reality of the situation that we're in is that it's still pretty uneven. In fact, what I hear quite a bit talking to organizations like this or my clients is that they're still missing that one golden screw that is a key input for production and is holding things up. That's going to continue to be something that we're going to focus on and keep an eye on. But the overall trends and what the leading indicators are suggesting is that further easing is likely for that supply chain pressure. And that's as suggested by the Purchasing Managers Index. That green line there is suggesting further easing within the supply chain pressures. And what this means for us in the US, and when we think about the overall activity of freight, is that it is starting to enter that slowing growth cycle. And this is another great indicator that is suggesting downward trends, downward momentum within your own sales. And that's the US Transportation Services Freight Index, that light blue line there. And this index effectively covers the activities of 4 higher freight carriers and tells us how the output of transportation services has increased or decreased from month to month. And we're seeing this activity wane again as the economy continues to cool off, as the global effects are taking away, we are seeing the level of trade, the level of freight, the level of overall activity continue to slow down. And that is the suggestion that these leading indicators are providing for your own monthly sales. So again, want to make sure that you're not overextending yourself and you are prepared for that transition that is to come. Now, gotta focus in on the local trends and say domestic trends for the US macro economy. And I want to pull up a chart here that we talked about during our last call, but wanted to re-emphasize a key trend, a key indicator of that upcoming recession, which is the interest rate environment. And this is really reflective of the rapid increase of the federal funds target rate that in the pressure that is put on the interest rate environment. And this yield curve inversion between the 3-month and 10-year yields tends a pretty statistically significant signal of an upcoming recession. In fact, 7 out of the last 8 times that we've seen that 3-month yield curve pop above the 10-year yield curve, we've entered recession. That's about an 88% statistically significant signal. Now, not only does this send signals as to when the economy enters into recession, it also sends signals as to when we exit a recession. And so we want to continue to keep an eye on that interest rate environment because it does have a strong relationship to the industrial production and manufacturing within the US economy. And so we've launched this program or this web series called Fed Watch, where our CEO and chief economist, Brian, is posting weekly videos about 5 minutes long, usually on a Thursday or Friday on YouTube. And I've dropped a link in here into these slides so that you can maybe have some access for a afternoon coffee break this Friday to check these out, because it's very important to stay on top of that Fed's tone, because the interest rate environment is a real key driver to where we head next. If we focus in on some of the key trends within monetary policy, the most recent meeting notes from the Federal Open Market Committee meeting that happened shows that the 25 basis point increase that they announced and released was somewhat debated. And even though there was a unanimous decision to increase the federal funds target rate, that just sends signals that they are thinking about taking their foot off the gas, which would be good for our outlooks at ITRC. We've expected them to really cap that terminal rate around 5 to 5.5% and around this timeline. And so anything that would push above and beyond those expectations, which would be subsequent increases in that federal funds target rate, would pose risk to our outlook. Another key trend that we are recognizing from the Fed's words and their actions and their notes and analyses is that they are anticipated to continue quantitative tightening within the money supply into 2025. And this is not going to be through federal funds target rate increases, but rather the diminished cap of reinvestment of those principal payments receipts. And so the tightening of the money supply has the potential to pose some downside risk to our forecast in 2025, when we're otherwise expecting the US economy to have a growth cycle again. And why this is so important is because of the strong relationship that the bond yields, the interest rate environment has on the US economy's ability to produce. And this is just a reflection of that relationship, where we're comparing overall total manufacturing production in dark blue to those bond yields in the light blue. And I want to note that those yields are on an inverted basis because there's a negative relationship here. So that is to say that anytime that the bond yields decrease, or anytime that this light blue line goes up, it means that those bond yields are decreasing. Anytime this light blue line goes down, it means the bond yields are increasing. And so we've seen that significant increase in bond yields as a result of that federal funds policies. And it's starting to pull back now as the economy is cooling off, as the Fed is somewhat taking their foot off the gas there. But there is a very long lead time here. You see the 30 months, in fact, of leading insights. That is suggesting waning activity within the industrial sector. And this all culminates within one of our flagship indicators of macroeconomic health, which is US industrial production. This is one of those charts where we are looking at everything everywhere all at once. Up top are those rates of change, the 312 and 1212 rates of change. Down below are the data trends, the 3-month moving average and the 12-month moving average. And really, the key thing I want to focus in on is that we are expecting that slowing growth, as indicated by the orbs over to the right here, throughout this year, and start to see those recessionary trends pop up towards the end of this year, but more specifically in 2024. Now, there's scar tissue, right? There's scar tissue from that R word, recession, where we go back to what happened in 2008 and 2009, almost a floor falling out from underneath us type event. That is not our expectations this cycle. You can see those orbs do not dip nearly as low as what they did in 2008, 2009. In fact, we're only talking about 2.3% contraction in 2024 year over year. And that's something that can be mitigated by planning for it and by focusing in on the markets of opportunity. But this is a very important indicator for your business. It's very correlated here, and it's about a 1 month lead time. But you can see that the downward pressure that industrial production, the light blue line, is placing on your overall monthly sales likely to occur. And there's going to be a fundamental distinction here that I do want to point out with these charts. Your sales are in dollar denominated figures, whereas production, that is just an activity, a volumetric based series. So there is a difference here between dollar denominated and non-dollar denominated series that we need to focus on, because inflation is still very much present, albeit in disinflation. But we need to make sure that as businesses, we are focused on that distinction as what is pricing growth and what is real growth. Pricing growth is great for setting budgets. It's great for looking at wage increases and things like that. Whereas the real growth, the activity and volumetric growth, is good for capacity planning. So make sure you're tracking both series, your dollar denominated series and your volumetric series. And I know we spent a lot of time last call talking about the health of the consumer. We're still seeing incomes rise on a real basis, so adjusted for inflation. And we are seeing a pretty healthy position, sound financial position from a debt load standpoint for consumers. But I want to spend just a quick moment talking about businesses. How are businesses doing? Because that's going to be really important for business to business spending. First way that I can conceptualize this is to focus in on the health of their finances. And this is a snapshot of delinquency rates and bankruptcies for commercial and industrial loans. And that delinquency rate in dark blue has been a pretty stable number. You know, we've seen it be lower in the 2014, 2015 time period, but we haven't seen that steep inflection and ratchet upwards that would suggest that businesses are getting overpressurized from the ability to service their loan. And when we look at the bankruptcies, that light blue line, they're definitely on the rise, as would be expected from the economic environment that we're in, but from a historically low level. Looking back over the past 20 years, we're talking about very low business bankruptcies. So sound financial position for businesses that will help buffer the cyclical decline. Gotta focus on their money and their cash available. And, you know, during the post-COVID sugar rush, things like liquidity, that light blue line, got way overstimulated and way oversurged. And we've seen a pullback and get more back on trend, but liquidity is still pretty healthy from a historical context. And then when I focus in on profits, that dark blue line there, profits also had a pretty strong run up during 2021, 2022. And at the end of 2022 and the first quarter of this year, we're starting to see the pullback occur on profits. And this is going to cause some hesitance with businesses and pull back on their overall spending plans. And why this again matters is when we overlay the rates of change of US corporate profits in that seafoamy line, you can see that there's about a 7-month lead time that is going to suggest upwards downward pressure within your own sales. So that upcoming transition from phase B accelerating growth that you're currently in to phase C slowing growth is still part of the analysis here that we are focused on. And so the next step of businesses that I want to highlight is inventories. And so inventories got way oversurged, and this was looking at fabricated metals inventories that got well above trend. And part of this was the pullback, the supply chain issues that folks were facing, as well as just the challenges of trying to keep up with demand during 2021, you can see that those inventories got pulled back during that time period, and then they got way overbuilt, way above trend. And this is something that's going to be worth keeping an eye on, making sure that you are budgeting for reduced inventory turns, not overextending yourself and sitting on high price inventory because we are in an inflationary environment, and recognizing that the likelihood that your sales opportunities as well are going to ease as a result of other businesses having high levels of inventory. So this is kind of looking at the fabricated metals, but if I focus on just durable goods as a whole, I can see this snapshot here where there's a great leading indicator of sales to inventories in green that is suggesting that the inventory growth is going to abate and cool off. And so that sales to inventory ratio has gone negative for several periods now, and is placing that downward pressure on inventory. So again, just some of those headwinds from an inventory standpoint is something that you all need to plan for. And it got to keep a finger on the pulse of business sentiment, because this is how decisions are made. And another great leading indicator for your sales is business confidence. Business confidence is just going to be the willingness of businesses to reinvest within their product offerings, explore new markets, and effectively continue to increase those inventories or not. And you can see business confidence has been pulled down quite a bit, and it does have a very long lead time to your monthly sales. We're talking about 16 months. And so the transition, again, further signal to that slowing growth. And when I factor in the environment of those profits starting to ease and wane, and inventories being overbuilt, and business confidence being negative from this perspective, it's all giving rise to our outlook for non-defense capital goods new orders. And this is really a proxy series for business to business spending, where we're focused on just the activity in that space. And again, another busy chart where we're focused on those 312 and 1212 rates of change. And you can see, again, our forecast here, where we are expecting that slowing growth to continue and then enter into recession beginning of next year, specifically, not a floor falling out from underneath us recession, but a pullback. Now, this is what I do want to focus on during today's call, is that some markets are going to be more insulated from this downturn than others. So making sure that you're tracking your individual markets, making sure that you're positioning yourself to the markets of opportunity is going to be helpful in helping you avoid maybe this recession in your own data. And that's going to be key, because during a great recession type event, it's hard, right? All gravitational pull of the economy was so strong where all folks were generally pulled downward during 2008, 2009. Whereas we're talking about a much more mild type recession, especially compared to the Great Recession, but even in the historical context, a more mild than usual recession as a result of the healthy finances of consumers and businesses, the ongoing reshoring trends that are going on, and the backlogs as well. So while the recession might be a macroeconomic event, it doesn't necessarily have to be a microeconomic event. And so when we think about the US economy as a whole, I do want to kind of highlight a couple of things, right? There's a lot of noise right now. Headlines are very busy, especially when we talk about the debt ceiling. We have a lot of insights that we've published on the debt ceiling. If you're not tracking ITR's blog, our CEO recently outlaid a blog about the debt ceiling drama, a lot of the political theater going on. Do you want to point out that Congress has managed to increase the debt ceiling on 78 occasions since 1960? So try to ignore that political noise. And while the conversations are ongoing right now, we should likely have some more insights upcoming. And the likelihood is that we at ITR will analyze, however the dust settles, whether the US defaults on its loan for the first time in over 200 years, which is unlikely, or spending cuts are agreed upon, or tax increases are agreed upon, or there's an agreement to suspend the debt ceiling limit. We'll be on top of it. And again, there's always these additional resources on ITR's website for our blog posts and our podcast, which we call Trends Talk. So highly recommend keeping that finger on the pulse. I know we will be. But when I focus in on the key trends for the macroeconomy and what the data is telling us, is that inverse yield curve is signaling decline for 2024, that upcoming recession. but the echoes from COVID will impact different industries differently. And I do want to spend some time talking about that. Watch those Fed watch videos, right? And keep an eye on that inverse yield curve. This is something that you can track on your own. The Federal Reserve Economic Data has some great resources and has an actual measure that looks at the 10-year and 3-month yield curves. But also recognize that because this is a smaller type of recession, there is the opportunity to make those investments in your businesses, especially if we're talking about investments in process efficiencies and automation, because the labor challenges, while they'll get a little bit easier, are not going to get easy. So anything that you can do to help abate those challenges and help abate the heightened costs of wages will set you up for that growth that comes in 2025. Now, I've kind of teed this up a couple times. Your markets, let's dig into them. What is going on with some of your microeconomics? And the first place we can start is talking about construction machinery new orders. And you can see, just like your average annual sale, this is an upcoming transition to slowing growth. And really, we need to focus in on what's going on in the construction market. Residential construction has slowed down quite a bit. Housing starts are in recession as a result of the affordability challenges that are underway as a result of the heightened mortgage rates and elevated prices. And that's our expectation, is that this environment will feel that pullback, enter into recession really this year. We're talking about 6.5% contraction by the end of 2023 as compared to 2022. And that will be followed up by further contraction in 2024. I think another piece that we'll need to focus on is the mining activity, excluding oil and gas, which will also hinder some of the demand for new orders. Follow that up, though, with a rise in growth in 2025. Talking about North America light vehicle production, this is a space that is still in that accelerated growth. And this might seem a little counterintuitive, right? Because interest rates should certainly impact the auto sector. And they absolutely are, and they absolutely will. But what we saw with the vehicle space specifically was during the post-COVID era, a significant challenge with getting those semiconductors in place and, making sure that the lots stayed full with inventory. And while the supply chain issues have eased, the semiconductors are a bit of a laggard there, but we are seeing the semiconductor supply chain challenges significantly abate really since the latter part of last year. And this has given way to a rising trend within vehicle production. Now, with that said, we are seeing that inventory, like U.S. light vehicle month-end inventory, is up 21.9% from the year ago levels. That's suggesting that the light vehicle industry is oversupplied relative to the current demand, and that's going to place downward pressure on production. And we're anticipating that decline to take hold really around the end of this year, but then more specifically into 2024 and recessionary trends there. So if you are feeling the upside pressure from this market, know that it is likely to wane throughout this year. Talking about tangentially related industry is heavy duty truck production. And this is one that we recently revised our forecast, as this segment of the economy is trending more in alignment with the industrial sector than the light vehicle sector. And we can look at the Cass Freight Shipments Index, which is a measure of freight volumes that's indicating demand for freight transport is slowing, along with the deceleration that's going on in total wholesale trade. And we expect that production 12-month moving average will peak in the near term as economic activity slows and manufacturers clear their backlogs. Subsequent production 12-month moving average decline will extend through 2024. We're talking about negative 8.4% year-over-year contraction through 2023, another contraction through 2024 of a 4.4%, and then finally growth to come for 2025. Again, kind of staying within this space, we can look at oil and gas extraction production. What's really interesting about this space is, thinking about what's going on with OPEC. OPEC, about a month and a half ago, I think at this point, made an announcement that they're going to cut their oil supply. And this is, in an effort to put upward pressure on prices, though that upward pressure on prices from a supply dynamic is being counteracted by downward pressure in demand. Despite a slight uptick in April, the crude oil prices, 3-month moving average is generally declining, as is natural gas spot prices. And that's signaling that both the oil and gas components of production will face continued downward pressure this year. And we anticipate that slowing growth will culminate in a hard landing, albeit a pretty mild one. If you look at the data trends here over to the left, you can see if you squint, some downward pressure here, but generally flat. So again, maybe one segment of the economy that is a bit more buffered. We're talking about 1.3% contraction year over year for 2024, and some potential opportunities to buffer your own cyclical decline in this space. Something that we'll want to, again, keep an eye on is what OPEC is saying and what they're doing. If they continue to cut their oil supply, that could place some upward pressure on those prices. And does that incentivize more local extraction in the US for oil and gas? I don't know, another segment of the economy that we do like to home in on is the medical equipment and supplies production, which generally moves kind of on its own. It typically has its own kind of ebbs and flows, but this is one where we are seeing a very similar type cycle coming up as the broader macro economy. That slowing growth through this year, followed up by contraction next year. When we look at medical and diagnostic laboratory services revenues, those are declining, and that space did get certainly oversurged as a result of the post-COVID or even in COVID sugar rush. Meanwhile, hospital margins are razor thin amid high material costs and shrinking reimbursement rates. These factors suggest that funding for medical equipment is diminishing among industry participants. And so we anticipate that downward cyclical momentum will be the prevailing trend for production in the coming year, albeit mild downward. So again, it's more mitigated than some other industries. Talking about a space that will run a bit counter-cyclical to the overall economy is civilian aircraft equipment production index. And this is one that during COVID fell off a cliff, right? Air travel was generally suspended. That caused a significant pullback in production, as you can see in that chart to the left with the 12-month moving average. And again, the floor falling out from underneath us as a result of COVID. But we're getting back. We're growing, not necessarily to where we were in the mid 2010s, so 2014, 2015, 2016, but still a rising trend here in growth. And when we look at travel demand, that is on the rise, and airlines are responding by adding capacity. Available seat miles are 7.1% below pre-pandemic record highs and generally rising. I don't know if anyone else has taken a flight recently, but the pilot has come on a couple of times on my recent travels where they said, yeah, it's another full flight. Last flight was full. Our next flight will be full. And that's because we're getting back out there. In addition, when we think about the heavy concentration within this market, we got to talk about what Boeing is doing. And they announced in May that Ryanair was placing an order for 150 of its 737 MAX planes with an option for an additional 150. Boeing also announced orders for at least 3 of its premium ultra-long-range Boeing business jets by private customers. And so rising demand and plans for additional production all bode well for production growth in the coming years. We anticipate ongoing 12-month moving average rise into early 2025 and surpass the prior 2015 peak with subsequent declines through at least year-end 2025. You can see we're expecting to really from those 12-12 rates of change hum along over the next several quarters before that slowing growth really takes hold in 2024, but into 2025, culminating in a mild recession in that data. Again, talking about 0.8% contraction in 2025. And again, due to the highly concentrated nature of the aerospace industry, relationships with clients and suppliers are critical here. So ensuring your customers are aware of your competitive advantages are crucial so that you may benefit from this period of growth and again have some buffer into the cyclical decline that we're otherwise anticipating. Another market, talking about computer and electronics. This is last but not least. This is a space that we are seeing a good momentum from the electrification that is going on within the economy. And when we think about consumers being in a stable position, some further growth to come here, but their spending on goods is slowing. And that pace of rise is going to be prevalent here over the next coming quarters. And given the current environment of elevated inflation as well as growing macroeconomic uncertainty, it's likely that some consumers will cut back on discretionary spending, and such cuts could apply to both upgrades for existing computers and electronics and purchases of additional goods. This will contribute to the expected 12-month moving total decline in 2024. We're talking about a 1.5% decline, whereas 2025 will be a year of recovery and rise for the macro economy, but also this segment. But again, we're talking about just a very mild 1.5% decline in this space. So still some opportunities of growth in the coming quarters and some mild recessionary trends from there. And bringing this all back up, right? It's very, very important to kind of think through the core implications of what's going on in the macro economy. I know we spent a lot of time in our last call talking about the inflationary environment. I did want to highlight that we are still seeing disinflation ongoing. When we break it down and we talk about just the different prices and the unevenness of those prices in the economy, can focus on commodities, which are feeling the disinflation and deflationary trends faster. When we think about things like steel and copper and oil and gas, those have been in a deflationary trend with some upward ticks within them as a result of the China reopening, resurgence, zero COVID policy reversal. But the broader trend in commodities is that deflationary outlook. But then when we bring it back to, say, producer price indexes, they're generally counterbalanced with those raw materials in the wage environment. And so, again, we talked a lot about labor during our last call. Right now, we're seeing that wages are remaining stubbornly high, talking about 6.1% year over year growth in U.S. average annual wages. And this is really a product of the tight labor market. And while we're expecting things to get easier from a labor standpoint, we're not expecting them to get easy. While job openings are getting back towards that long-run trend, that long-run trend was on a growth trajectory for overall job openings. So labor market is going to be a trend, those tightness throughout the rest of this decade. Keep an eye on that. But we should start to see that attendant easing of wage inflation. And when we think about inflation, we do need to highlight the differences between the sales activity that you have going on and the real activity or volumetric. So sales expressed in units, so thinking about the volumetric data, will trend lower than nominal sales data as a result of the inflationary environment. And consequence of this inflationary environment, outside of all the things that come from heightened prices, is that the Fed has been very aggressive in combating it, and their actions have given rise to an inverse yield curve. I do want to make sure that we are providing the resources to stay on top of that Fed tone. So want to make sure you're joining us for that Fed watch to keep that finger on the pulse in between these quarterly updates. While this inversion has given rise to a recessionary outlook, there's a lot of things about the economy that suggest it will be a mild recession. Again, talking to the reshoring and onshoring trends, talking to the consumer health and the business health, these will all buffer the cyclical decline. We do expect it to be mild from a macroeconomic standpoint, and we do expect there to be unevenness by market. And that's typical during business cycle declines, where there are market winners and market losers. And focusing in on those winners can help make sure that this macroeconomic recession is not a U recession. Focus on your geographic regions. Thinking about the broader United States, there should be very different expectations for business opportunities in Texas, the fastest growing economy in the US, about 4.4% GDP growth, versus Louisiana, right? Those are two key distinct markets. Also focus in on those different market segments. Again, going back to the report, finding the areas that have more buffer, more buffer within that cyclical decline, or just outright counter cyclicality, like aircraft space. When we think about the regions and think about the demand drivers, we got to focus on where the economic diversity exists and focus on the demographic trends. People drive the economy. And those are going to be the influencing factors of where you can focus your own efforts. So these sessions, they're always like drinking from a fire hose. We usually want to save a couple minutes here for a Q&A session. So I want to open it up, see if anyone has any thoughts, comments, or questions based upon the report, based upon things going on in the economy that you'd like to discuss now. I think all you need to do is just unmute and speak up, and we can just keep it a nice organic conversation from here. If no one has any questions, I'm happy to send out my my email address so that you may maybe send me an email rather than having a conversation now, and happy to re-engage with one another. I do have a QR code up here for ITR Insider membership. If you scan that, you can just kind of dig in and keep a finger on the pulse of what we're thinking, what we're seeing in the markets and the overall activity. And again, have some of those insights in between these review sessions. Give it another minute here. I'm an economist, so the awkward silences don't bother me because I am awkward. See a nice thumbs up. All right then. So in that case, I will give us all back 4 minutes of our time. If you do want to shoot me an email, happy to do so. It's PLUCE@ITR Economics. Feel free to reach out, and happy to chat about whatever comes to mind. Hope you all have a great day. Look forward to checking in again in a few months. Take care, y'all.